Markets are holding their breath ahead of the Fed Reserve's interest rate decision. Almost all major instruments have been trading sideways over the past 24 hours. Market sentiment will depend on this policy meeting. It's not about the next level of the funds rate. There is no mystery there. It's clear that the key interest rate will be cut by 0.25% today. Even forecasts for further rate cuts will also be downgraded. The only question is, by how much? It's the perfect moment to focus on the dot plot, which is released in the US alongside the Fed's interest rate statement. It looks something like this, with each dot represented in the view one of the 19 Fed Reserve members on the future path of interest rates projected for several years ahead. The current dot plot suggests that the US will see 4 rate cuts next year, totaling 100 basis points. However, most experts believe that the most likely scenario for 2025 will be reducing the figures to at least 75 basis points. With such forecast, the US dollar recorded its highest value against its 6 major competitors at the start of the week. On a Monday, the US dollar index retested its high of November 26 at about 107.18. By Wednesday, the index was trading slightly lower within the range of 106.80 to 107 points. Meanwhile, the euro, taking advantage of the temporary market lull, managed to hold its gains around 1.0505. The single currency's rise was partly supported by reports on inflation levels in the eurozone. The annual CPI accelerated from 2% to 2.2 in November. However, forecast had expected a higher figure of 2.3%. Despite this growth, the euro-dollar pair remains close to its 2-year low, hovering around 1.04. However, there is a possibility that the pair could have a short-term rise on the short positions. The euro's rally is anticipated closer to the Christmas and the New Year as the traders begin looking in their profits. Beyond that, things are likely to worsen. Volatility may ebb away completely along with the trading volumes. The expected pause by the Fed Reserve combined with the ECB's further rate cuts is likely to drive the euro further downward. This was confirmed by ECB President Christine Lagarde, who stated on a Monday, "The direction is clear and we expect further rate cuts." The primary reason for the divergence in the plans of the Fed Reserve and the ECB lies, of course, in the economic fundamentals. Indeed, economic conditions in the United States and the Eurozone are opposite. The US reported rise in retail sales and a forecast of an economic acceleration in Atlanta from 2.8% to 3.1%. In contrast, the Eurozone is plagued by one political crisis after another. Besides, data from Germany discouraged investors, prompting experts to discuss the risk of a recession. Regarding the oil market, a rate cut in the United States would be bullish for the oil prices. Such a move could bolster economic growth, which would in turn boost oil demand. Additionally, reports published earlier today showed a larger than expected decline in the US crude oil inventories. While forecasts anticipated a drop of 1.9 million barrels, the actual figures were 2.5 times higher, showing a decrease of 4.7 million barrels last week. On the other hand, Germany's feeble economy and concerns over demand in China are exerting downward pressure on oil. As a result, OPEC and its allies not only postponed increasing oil production until April 2025, but also extended the complete removal of restrictions for another year. As we mentioned earlier, most assets are consolidating within sideways ranges near previously reached levels. Brent crude is no exception. Anticipation a boost from the Fed Reserve's rate cut, Brent crude is now trading slightly higher within the range of 73.10 to 73.80 per barrel. As for the Russian ruble, the situation looks complicated. To recap, a decree mandating exporters to sell a portion of their foreign currency earnings has been in effect since October 2023. Over time, the required percentage has decreased from 80% to 36%. Now, exporting companies can even seek permission from a special commission to further reduce their allocations. Meanwhile, sanctions restricting the Russian financial system are reducing the flow of foreign currency into Russian capital markets. In other words, the amount of the US dollars available to Russian companies is shrinking. Reserves are depleting, and with them, the exchange rate of the Russian ruble against the dollar and the yuan is falling. Could the situation change after the Bank of Russia's decision? Its meeting on December 20 promises a new record hike in the key interest rate. For more insights into how economic statistics impact currency positions, check out our traders' calendar. So that's all for today. We monitor developments in the financial markets, subscribe to our channel, and stay up to date with the latest news with us. See you online soon.